How can I make myself more competitive?
How do I build my network?
I want my career to go to the next level, but I don't really know where to start.
I hate the job I am in. What else can I do?
I want to work in healthcare, but I don't want to be a doctor.
I need connections in a new industry. Where should I start?
Whether you're a college student trying to decide on a career path, a young professional trying to develop their career, or maybe you're in the mid to late stages of your own professional journey and you're looking for a new challenge, or maybe you're facing an unexpected job search. Whoever you are, wherever you are, welcome to the Professionists podcast. And together, let's find your fit. Before we jump into it, a little bit of a disclaimer. We're going to talk about financial planning and financial awareness today, and just be aware that what we're going to talk about is generalized advice, and you should always seek the advice of a financial professional and or an attorney, and you should always be informed about your own investments. Nothing that we talk about today should be construed in any way as professional financial advice, and just make sure that you are informed before you invest your own money. Without further ado, let's jump on in. A recent article on Forbes.com details a 2020 report from the Social Security trustees that suggested that Social Security could be insolvent as early as 2035. Whatever the outcome, it is safe to say that relying on the existence of Social Security alone is a very high-risk play, with the reality being that even if it does exist, it is unlikely to be anything like the number you have in mind. This means that careful and deliberate financial planning from a young age is crucial. However, it has been a failing of our education system to teach children and young adults the reality of money and how to gain, grow, and use it in positive ways. For many young professionals, their education is focused on the technical knowledge, with little to no information on how to manage the money that they'll earn when they enter professional life. For all too many folks, no real thought of financial planning or stability is given until it is late in the game, albeit hopefully not too late. While the tendency is to ostrich and stick our heads in the sand, the best course of action is to prepare ourselves with the knowledge needed to do what we can for as long as we can to prepare for the future and the uncertainties that it may hold. Today's guest is someone who has a very real and passionate interest in financial education, having written widely on the topic since his time in college. Following his college degree at Baylor University, he joined Accenture, where he worked as a management consultant and led a financial literacy team that grew from 5 to 60 volunteers and provided education on budget, investment, and retirement saving strategies to over 15,000 Accenture employees. He's written more than 200 articles, which have been published widely, including in the Washington Times. He is a fan of craft whiskey distilleries, chess, is a proud father and husband, and he is presently pursuing his MBA at the University of Chicago's Booth School of Business. He is Danny Huizinga. Danny, welcome to the podcast.
Thanks so much, Ben. Great to be here.
As I said in the introduction, this is a topic that I think makes a lot of people really anxious to think about, because it can feel like if you don't get onto this early, that you can feel really far behind. Let's start by diving into, how did you learn about money?
That's a great question to think about. Honestly, I think I benefited a lot from having parents who cared about money and taught me a lot as a kid. I still remember my dad taking me to get a high school checking account at Chase Bank. This was back when people used to walk into banks and sit down and fill out forms to open checking accounts. And I probably had, $50 in there when he first opened it. But I think just that process, my parents gave me a small allowance every week, and I had to use that if I wanted to get ice cream with my friends. It helped me kind of build that practice of learning how much I had.
Did they tax your earnings?
They didn't, but they did encourage me to give a tithe every week, which was really good. I had to put $1 of those 10 into a separate box that I would bring to church every Sunday. So, I think that just helped build those mindsets early on. And as time went on, my parents taught me about credit cards and investing and all that stuff as well. And I think I just realized at Baylor that a lot of people don't have that benefit. And I thought, hey, how can I share what I learned from my upbringing with other people?
I think it's one thing to have parents to teach you, but what is it that took it from kind of entry level knowledge to where you are now? What made you want to continue to learn about how to gain, grow, and use money well?
Yeah, that's a great point. I think for me, a big change came in college where I was studying finance, and I thought that's where I would kind of learn how the stock market worked and what smart decisions I could make. And even though I took some great classes in investments and corporate finance, I didn't actually learn what to do as a personal investor. And so I kind of started trying stuff on my own. I didn't always ask my parents for advice. And I made some mistakes, quite honestly. For example, oil prices went way down, I think my junior year, and I thought, oh, well, they're going to come back up, so I'll buy low and sell high. Well, I bought some fund that tracks oil prices my junior year, and 5 years later, I realized, okay, they're still stuck low, and I just ended up selling it for a loss. I gave up, right? But at that time, I thought I knew what I was doing, and I absolutely had no clue. And so I think it was maybe those failures that helped me think I need to figure this out on my own and do some of my own research to actually build wealth in a way that is relevant for me.
Well, that was going to be my question: is what was the first lesson you learned? And it sounds like that was a pretty important one. I think I'd ask you, where did you do your research? Because it seems like every man and their dog has a YouTube channel or a social media account touting, Barstool Sports, for example, blowing up with Dave Portnoy and his game stonks and all this kind of stuff. So, and people are getting advice from all kinds of different places.
Yeah.
And we live in an age where there's just massive influx of information. How did you cut through that and figure out what was actually worthwhile advice?
Yeah, and I think I've made some mistakes here as well. One of the biggest things of advice I always tell people is be really skeptical. Like you said, there's a lot of people out there who are trying to give advice, but they're really trying to sell something to you, or they're trying to get something from you. And so for me, I think one of the best places I found was NerdWallet. So just nerdwallet.com is this great startup in California. Just a few hundred employees, but they really focus on giving like honest, good personal finance advice, and they're not trying to sell you or get you to buy a product from them, which makes a big difference. And they have a ton of calculators for you to estimate, how much rent you can afford, or should you refinance your student loans, all that kind of stuff. But really, I think digging into that, and then honestly reading, there's a Wall Street Journal personal finance column that debunks a lot of the myths out there and references some good books to check out. So there's a few books that I've found just really helpful in helping me helping me learn how to think, which helped me expose some of the lies that people in the industry try to tell you, and gave me my own perspective on knowing what to look for and what to avoid.
What are your go-to resources now?
Yeah, so NerdWallet's still my go-to. I think there's a great new book called The Psychology of Money by Morgan Housel that just came out. So that's a really great starter book if you want to kind of think about your financial life, like how do you think about that emotionally? And he tells some great stories that I think really resonate. So even if you're not a finance or stock market person, it's not a book of statistics and numbers. It's really a book of emotions and how financial decisions make your brain work. And again, how you can make decisions that give you independence rather than kind of being stuck into some of these arrangements where companies are pulling fees from you for the rest of your life.
Yeah, that's probably a good place for us to turn. Just generally, as I said in the beginning, this can be a really overwhelming topic, and especially for the older you get, the more overwhelming it can become. People in their 20s and the 30s, there's this temptation to think, I'll get to that. I'll get to that in a little bit. It seems like a long way off. But once you get into your 30s and 40s and beyond, it can stir this sense of nausea in your stomach when you realize, good grief, I'm this far behind, or I haven't planned. Why is it important to start thinking about this as early as possible? And perhaps what hope do you have for people who maybe are coming to this a little later?
Totally. That's a great question. I think that the phrase I often use when I'm teaching people about personal finance, as I've done in a number of cities around the US, is this phrase, start as early as you can, but it's never too late. right? So at no point should you say, well, I missed it, might as well not bother, right?
Yeah.
It's the moment you're thinking about it, that's the best time to start. And so, if you're just graduating college now, then great, today is the day. If you're 40 years old, still, might as well start today. And it's hard, I think, for us sometimes to think about how important that is. And there's some visuals that, or kind of estimates that we could share just in an article I put together after this. But I mean, even if you spent just your 20s putting in a few $1,000s a year into retirement savings, for example, which is, it sounds like a lot of money, but maybe that's 10% of your first job out of college or something into retirement. Even if you spent your 20s doing that and then never contributed again, you'd have a few $100,000 saved up for retirement. Whereas if you waited until you were 30, you would have to contribute that entire time from your 30s to your 60s to really get the same amount, just because you missed 10 years of what we call compound interest, which is you start early, the benefit just takes off and keeps growing more quickly. So that's why, especially if you are in your 20s, again, like start as early as you can. I think it's just thinking about that fact that you really need to motivate yourself to do it now, and your future self will thank you when you have hundreds of thousands of dollars that you can use to take trips or to pay for your kids' college or whatever it is that you're hoping to do in
Yeah.
30 or 40 years.
It sounds like the point from that is start as soon as you can. And
Yeah.
that sometimes is the hardest thing, is how do you start? What would be your piece of advice for someone who's in that situation, whether they be a 21-year-old just about to come out of college or a 35-year-old who's like, gosh, I haven't saved anything. How do you start?
Totally. Yeah. So for me, I think it's easy to break it down into a few key steps that you can take. So first, even before investing, I think it's worth really thinking about building up some type of emergency fund, because at some point something's going to happen in your life, whether it's the financial crisis or COVID, and you might lose your job, or you might really want to quit your job because you're getting burned out or frustrated, and you need to have some type of cushion so that you can pay rent and buy yourself food or feed your dog or whatever it is, right? So
Yeah.
that you're not out on the street. So investing is super important. It's great to start early, but I always say, like, try to give yourself at least 3 months of expenses in an emergency fund. And that's something that you really shouldn't invest. That's something you're keeping in cash, or maybe a high yield savings account that doesn't have risk. And that's just kind of your comfort to know, hey, if something goes wrong, I'm not going to be begging on the street next week. I'm able to kind of float through it. But once you meet that, I think, really thinking about planning for your retirement early can be intimidating. But a great first step is that most employers offer a retirement plan, and many of them will actually match some amount of money as well. And so always try to at least put in that amount that your employer will match, because you're really doubling your money instantly for free. And so sometimes it's 3% or 5% of your income, and that's usually a pretty easy thing to do, and it comes out of your paycheck before you even see it. So then you can kind of tailor your expenses afterwards. You're not even really missing it. And that's just a good first step. And from there, once you've kind of gotten those basic things down, we can talk about a lot of other opportunities you can take on your own. But those two things, you'd be amazed, probably half of America doesn't actually do those two things. And it really comes back to hurt them when they're retiring and trying to figure out how to pay all those bills.
Yeah, I mean, budgeting is a big part of this, right? So what advice would you have for someone who maybe hasn't done a budget before,
Yeah.
maybe is scared to do a budget, to kind of
Totally.
see where they're spending their money? What advice would you have on actually starting to get a picture of your full financial situation as it is now, and to figure out where you can cut back, where you can start taking money from spendings to savings?
Yeah, I think the biggest problem for budgeting is not one of ability. It's not actually that hard of a thing to do, and there's so many startups now that make it easier. But really, it's motivation, just like working out, which is something I admittedly struggle to do as much as I should.
You and me both.
Yeah, right. It's we all know we should do it. We all know the benefits. It's not actually that hard. I mean, now there's so many workout apps and everything. But the reality is, you need to force yourself to do it twice a
Yeah.
week or whatever. And
It's a
not
discipline rather than something you are motivated to do.
exactly, and it's not always fun when you do it. It's I think just like budgeting, working out is more fun if you do it more, because it becomes a habit. You start to enjoy it actually a little bit. It sounds weird, but it's true. So I think some of the same things apply. I mean, for me, the best thing for both working out and budgeting is find a friend you trust and have some accountability. And so maybe that's a close friend from college, or maybe that's your partner if you're in a relationship or something, and do this together and actually take time to say, hey, every other Saturday, we're going to take 30 minutes and we're going to look at our own budgets. And maybe you even trust this person enough, you're willing to compare and say, oh, weird. Like, I go out to eat 3 times as much as you do. Like, look how much I could save if I was a little bit smarter here. Or even for me, I remember comparing budgets with a friend once who she bought her friends massive wedding gifts, which is a great, generous thing to do. But she just assumed that everyone should buy their friends like $300 wedding gifts. And then I think we realized, oh, actually, like most people don't spend.
There's a lot
much.
of tea towel sets at weddings.
Yeah. Right. It's like,
Boards.
sure, that's a great thing. And if you enjoy that, awesome. She just assumed that was kind of the normal, right? And it was only through talking to other people that she realized, people actually spend more like 50, 100, right? So that's something helpful too, is it helps benchmark maybe where you're a little bit outside the normal. But then, like I said, really, as long as you have that accountability and some type of cadence, whether it's, once every week or 2 weeks, there are so many apps that make it really easy. So if you want, you can build your whole sales spreadsheet and track it manually. I know some people who do that. Personally, I don't think it's worth the time. So I use something called Mint, which is a super popular app.
Great app. Yeah.
Yeah. So super easy. You hook up your financial accounts and credit cards. It syncs all your transactions. And for the most part, probably 97% of the transactions it categorizes correctly. Sometimes you have to tell it, that this is a coffee shop and not a clothes store or whatever. But once you kind of get that going, it's really easy to take just 10 minutes a month and say, okay, I spent roughly this amount this month on these different categories. And you don't have to be militant about it. But to me, I think it's just helpful to know what those numbers are so that when you're talking to people, you know kind of where you stand and you know what's driving your expenses. And you can start thinking about, hey, how can I actually meet savings goals I have for retirement? And maybe an easier way to do that is, contribute to savings first. Say, hey, I'm going to put 10% or 15% into retirement at the beginning of each month or right when I get my paycheck. And then you can spend whatever you want for the rest of the month. You don't have to sit and feel guilty for going out to eat because you've saved already. And maybe flipping that script helps a lot of people as well.
That's a great piece of advice. Investing is something you've mentioned a couple of times as a way of increasing the amount of money that you have in the longer term. And it's become very, very popular. In the last few months in particular, I think a lot of people have been working from home. So they've been incentivized to maybe get involved in the investing world, to learn some more. There's a lot of amateurs out there. We saw the GameStop or the hashtag stonks kind of trend a few weeks and months ago. But there's also a lot of casualties when it comes to investing. So help us understand why trading your own stocks or buying individual shares in a company might not be the best place to start.
Definitely. There's a great article I just published on this a month ago that we can share afterwards as well. But yeah, I think the GameStop saga has really, really demonstrated the problems of this mentality. And to some degree, I think the existence of Robinhood as well has kind of made people think investing should be this fun game where you're getting wins, almost like a casino, and you can screenshot your account and share with other people and get rich quick. But like everything in the world that tells you can get rich quick, there's a ton of risk and a ton of downside if you're wrong, and many people are. And I think the GameStop saga is a great example. So sure, some people made 10, 20, 30 times their money in less than a week because they happened to buy GameStop stock and then it took off. But just as many of those people lost their life savings. I mean, the New York Times, the Wall Street Journal had some profiles on these people who took everything they had saved for their entire lives and thought, bought in GameStop at $400 thinking, well, it's going to 1,000. And look where they are now. Now they have none of that left. And I think you have to stop and think about, is the point of investing to get rich quick and never have to work again with a really low probability of that actually succeeding? Or is the goal to build up some security so that you don't have to stress in retirement about paying for things you'll need or paying your medical bills or supporting your kids or whatever it may be? And you can do that for a lot less risk than buying stocks like GameStop. I think for every GameStop, there was also an Enron, which many people might not remember, but the company that almost overnight, I mean, tripled its stock price. It was, the hottest company to buy, and then everyone realized there was massive accounting fraud. The company went to $0, and again, tons of people lost everything they had invested. And so it's really just important, I think, to be humble and recognize you have no idea what's happening at these companies. You have no idea what might happen. Maybe there will be another pandemic or something that could completely ruin some businesses. And do you really want to risk your life savings that you know more than all these professional investors in the world who are trying to do the same thing? And personally, even though I feel like I know a lot about this stuff, I'm pretty confident that I do not know more than those people. And so I choose, honestly, to take kind of a risk-averse strategy that in the long run will be better off for me.
Well, I think it says something too about emotion and the role of emotion
Mm-hmm.
investing. I got a buddy who's a day trader, and above his workstation, he has a sign that says "No emotion."
Yeah.
And just looking at numbers and just making cold, hard clinical decisions rather than kind of falling in love with the decision that you made that may be a bad decision and loving it to death rather than saying it's time to cut.
Yeah, and I have a friend who's a day trader in his free time, and he's lost probably $100,000. So
Yeah.
yeah, it's and yet he keeps doing it, right? So I think, at some point, people think, well, I mean, it's just like gambling. You think, well, I'll make it up next time. It'll make up for everything that I lost before, and you have to sometimes tell yourself, like, the best way to win is to stop doing this.
Yeah.
And I think people are starting to learn that. We're starting to see the damage, but the reality is, smart people, wealthy people are not doing these things. And so if you really do want to become wealthy, don't try to take a shortcut because you're just gonna you're just gonna miss out on honestly what smart, professional, successful people do, which is in general avoid high fees and avoid kind of these like quick hit, get rich quick schemes, and they just know to put their money in places that will grow over time and not overthink it. And there's a lot of great resources, I can share to get started in that regard. But that's the key is this really shouldn't be a fun, exciting thing. It should be something you kind of keep on autopilot and set it and forget it. Just like working out again, you're not going to, go for a run and win a marathon, right? You have to actually put in some dedicated work training and, and let it go from there.
Well, and if it sounds too good to be true, it usually is.
Totally. That's a great phrase.
Help us understand, first of all, what is an ETF and why might an ETF be a good idea as opposed to maybe just buying a bunch of Google stock?
Yeah. ETFs and mutual funds, which are similar in many respects, a little bit different, but we won't get into the weeds. So both of them are a great new invention in that they allow you to more easily diversify your investments. So I know that's kind of a word we don't hear very often. But like we talked about with Enron or GameStop or like you said, even Google, there's always that risk that the company could go bankrupt or even just have a huge decline in stock price.
Or regulatory changes that fundamentally undermine their business model.
Exactly. And honestly, sometimes it's not even that the company is doing poorly. Again, I think, remember that stock prices are only kind of like a social construct in some way, right? They are tied to profits to some degree, but also prices go up and down because investors think certain things are going to happen. So even if nothing changes at Google, investors might decide that Google or whatever company isn't going to be as good as they think it is, and the price could go way down. And so you aren't able to control that. And so really what ETFs and mutual funds do is they invest in a number of different companies. So you can have a stock ETF or a bond ETF, which would buy then a ton of different bonds. But you buy one share of that ETF, and then you get a little sliver of a bunch of different companies, which means if one of them goes bad or something happens or the price goes way down, you're really limited of how much exposure you actually get. You don't lose as much. Now, of course, that means you maybe lose on some of the upside, right? If Tesla's stock triples, you don't get 3 times your investment. You get a little share of 3 times your investment. But over time, it kind of smooths out some of that risk and return, and ETFs can still go up and down by a lot because the market is pretty volatile. But it allows you to have a little more predictability. And over your lifetime, if you're really looking to save for the long term and not make $1 million overnight, then that predictability is so worth it, I think, for the average everyday investor who doesn't want to spend all day researching this stuff.
Well, and too, there's a lot of people who will say, don't bother with these funds that are themed. Just get one that matches the market, because over time, if you track the market, you tend to do at least as well as a managed fund anyway. That's what I've heard and read myself.
Yeah.
What are your thoughts on that?
Yeah, so you bring up a good point. So just to clarify terms a little bit too. So we talked about mutual funds and ETFs, which buy a lot of different stocks or bonds, and you kind of buy one share of those. And underneath that umbrella of mutual funds or ETFs, there are several types of these funds. Now, some of them employ a lot of very highly paid wealth managers and investment bankers and traders who actually are trading investments all the time and trying to make money, and then they're charging you the fees for paying their salaries, often hundreds of thousands of dollars per year. And so those are things that are worth staying away from. As you mentioned, like a lot of those end up not doing so well. But then there's this relatively new invention called index funds that was really pioneered by Vanguard, which is a really great investment management company. And index funds, like you said, are just trying to track the market. So, no one is at an index fund trying to buy and sell stocks every day and find little ways to get a few extra cents and try to beat the market. They're just trying to say, how do we roughly be in line with whatever the overall stock market is doing? And so if some companies fall out of the best companies, and they fall out of that kind of tracking process, and only the companies that are doing well over time in the market kind of get picked up by the index. And so over time, if the market is doing well, then you're doing well. And as the economy keeps growing, hopefully for the rest of our lives, then you keep doing well. And you don't have to pay any of these, super highly paid people to try to make bets with your money. And the reality, I think, as you said, there's so many studies now that index funds outperform pretty much all actively managed funds, which are those funds where people are trying to trade.
Sorry, I said mutual funds. I meant managed funds, just to clarify.
Yeah, totally.
Thank you for clarifying that. Yeah.
Yep.
How much do I need to have for retirement? As, random individual, what's the figure that we should be aiming for is it based on what we're earning? Is it based on how much we expect to live off? Like, how do we calculate that?
That's a hard question that a lot of people ask, and NerdWallet does have a helpful calculator. I think that's good to plug in some assumptions and see. In general, right, it mostly depends on how much you think you'll be spending each year. Because the point of retirement, right, is at some point, let's say when you're 65, 70 years old, right, you don't want to have to go to work every day. You want to be able to live in Florida or to travel or whatever it is you want to do. But someone's still got to pay your mortgage or buy food or, buy flights or help support your grandkids' college, whatever. And so you do need some source of money that can kind of generate that income for you, because no one's paying you when you're retired. So really, I think the first step is think about, like, what do you think your expenses will be when you're retired? And that's a hard thing to do for a lot of us, because it's hard to know how much we're going to need to spend on medical care, and are we going to, go out to eat more when we're older or not? And so, I think there's some challenges there, and there's some ways you can try to estimate. But I try to say, if I even look at my expenses today and look at, okay, what do I spend in a typical year on all of those necessities I need? And then maybe even like add some to that, because as I have more kids or whatever, it's going to be more than I think. And of course, I'll have more healthcare expenses, everything. And then really, like, that number times 25 ideally is what you have, right? So if you spend, let's say $40,000 a year in expenses, which actually would be relatively low, again, depends kind of where you live and everything, you'd want $1 million in retirement. And what that would mean is, once you're retired, we feel relatively confident that you can withdraw about 4%, that total number you have, let's say it's $1 million, without getting rid of that amount. And so you're not actually depleting it, because it's still making returns and everything. So if you have $1 million, you make 4% of that every year, that's $40K. And you can use that to pay all those expenses and kind of keep that nest egg in case, you want to do something bigger as well. So typically that annual expenses times 25 is a good gut check. But again, I always err on the side of caution, right? Why not shoot for maybe 2 million or 3 million? And that might sound crazy, but again, even just putting in a few $1,000s a year starting in your 20s, that's very attainable. And you can run some simulators online. You'd be amazed how quickly that number takes off and gets you past that million mark.
It's probably a good place to transition to a slightly different demographic. So You've mentioned a couple of times about the importance of people in their 20s planning for this. Let's say I'm in my mid-40s, right? And I'm listening to this podcast and I'm really having that sinking feeling. To what extent is Social Security a part of your planning, if at all? And how does it work, and what are the pros and cons? Because even someone who's starting later may not be able to make up that shortfall to the 1 to 2 million that you're talking about. So what is Social Security? How does it work? And can we expect it to be there? Because, the reason I asked about the expectation is I saw a report, it was on Forbes.com, I mentioned it in the introduction, saying that there is a high probability, or at least a possibility, that Social Security would be insolvent by 2035. So, is it going to be there, and what is it? Help us understand that.
Yeah, and before we even go down that road too, I think, what, if you are thinking, wow, like $1 million, $2 million seems insane, remember that, like, it doesn't mean you're going to starve if you can't meet that number. Of course, many people retire with much less. It just means you might not be able to do everything you want in retirement. You might have to live somewhere cheaper. You might not be able to go out to eat all the time. You might not be able to finally buy that new car that you wanted when you're older. So, of course, you can still make smart budgeting decisions when you're older, but it's great to pay your future self and be prepared. But yeah, Social Security is a really interesting thing. And actually, that was my favorite internship when I was in Washington, D.C. in college, was interning for the Congressional Committee on Social Security, and learned a lot about the program and probably more details than you want to know about how it works. But the short answer is yes. In 10 years, Social Security will be insolvent. And I guess, really the trust fund we've built up, which is all these surpluses from prior years, is running out. We know this. And in about 10 years, we are going to have a big political compromise where we either raise taxes to keep funding Social Security, or we reduce everybody's benefits by, last I checked, I think it was 25 or 30%. I'd have to double check. I find it unlikely that they will do that. I imagine probably taxes will go up, but that's kind of a scary thing for us to think about. And the big driver of that is when Social Security started, there were a lot more workers for every retired person. And now we have, honestly, people not having as many kids. We have a lot more people retiring and many fewer younger people. And so it's harder for us to actually keep replacing the income that we need. So when I think about, will it be there for me? I think for me, I really hope it will be. I think politically we'll probably figure out how to keep it alive. But I like to plan as if it won't be there, because then Social Security will just be a bonus for me. If I'm not planning on it, then heck, it'll be great to have a few extra $1,000 every month from Social Security. But even if it is there, Social Security, the metrics we use to determine how much you're going to get, they're really based on replacing 40% of your pre-retirement income. So if you're using that method I talked about earlier to look at your expenses and kind of project your retirement income based on that, you're still going to have more than half that you'll need to get from somewhere else, because Social Security isn't even if it's still around exactly as it is today, it's not designed to replace all those expenses you'll need. So regardless, I think it's really worth putting away as much as you can. And even if you're 40, again, you still might have 20, 30 years of growth, which is huge. And just putting money into a retirement account instead of letting it sit in your checking account, or instead of upgrading your house or your car if you really don't need to be, those are big things that will pay you back later when, whatever happens with Social Security, you have that independence and stability that you don't have to worry about it.
Let's talk about 401k and 403b. What's the difference, and help us understand those concepts?
Yeah, so really when you think about retirement saving, there's kind of two main buckets, right? So one is employer provided and one is self-initiated. So both 401k and 403b are in that employer provided bucket, and they actually come from sections of the tax code. That's why we give them these weird, confusing names. So 401ks are typically for like for-profit companies. So if you go work at a consulting firm or a bank or whatever after college, that's likely what you would have, unless you're a smaller company, in which case they might not even have one of those and they'll set up something similar. 403b is typically more for nonprofits. So they function in many ways the same. It's just, again, like a different section of the tax code. But if you work for the government, you'll have something called a TSP, the Thrift Savings Plan, which again is very similar. But all those are just set up through your employer, In many cases, you'll get enrolled automatically when you start your job. And like I said earlier, many of these places will match your contributions to those plans as well. So it's an easy way to just double your retirement saving as long as you're maxing out that match. But then on your own, outside of those employer plans, you can also kind of go to that other bucket I talked about, the self-initiated bucket, and you can set up your own individual retirement account called an IRA, and you can do that anytime you want. And there's a bunch of different companies that will do that for you. I mentioned Vanguard earlier. We'll let you do that. There's a bunch of startups, Betterment Wealthfront. You can set up IRAs as well. So, there's a lot of places to start, and NerdWallet has a great list of kind of, if you want to do that, how to start. But, at the end of the day, they function very similarly. They have some different contribution limits, and you have to think about the different tax benefits you get from each one. But the bottom line is, they're all good for helping you save for retirement, and they all give you tax benefits because the government wants you to save for retirement. So as long as you're doing one of the above and just getting started, you can learn more along the way about strategies and everything, and that's a lot of what I talk to people about. But don't stress too much now about exactly what you need to do, and just, hey, jump in and start doing something, and you can learn more as you're making more money and putting more money into these.
Can you have multiple IRAs, or do you need to just pick one and work with that? Help us understand that.
Yeah. So you can have multiple. You do have a contribution limit across all of your IRAs, so that's just something to keep in mind. Like they do limit, I believe right now it's $6,000 that you can put in across your IRAs, and so you do have to decide, which ones you want to put in. For me, ultimately I prefer to have everything in one place if I can. So whenever you leave your job, let's say you had a 401k or 403b at your old company, you can choose what you want to do. You could leave it at that old company and keep your old username and password, and for the rest of your life, you can manage it there. Or you can roll it over into your own IRA, which you set up on your own through whatever bank or something, and that stays with you no matter how many times you switch jobs. So for me, I prefer to just roll them over. So I have one account. Right now I'm a student, and so it's great to have everything in one login. I don't need the old one anymore. I put everything in one place. But some people prefer to not do that paperwork, which is totally fine too. But I think simplicity goes a long way, especially in a complex financial world where we have so much already demanding our time.
Talking about complexity, help us understand the difference between a traditional IRA and a Roth IRA.
Yeah. So right, if you're in this world and trying to open your own retirement accounts, or even looking at your employer accounts, you'll see these two terms, traditional and Roth. And there's a lot of discussion and debate about these. Again, I think before we dive in too much, the bottom line is they're both great. They both give you tax benefits for saving for retirement. So pick one and go for it, right? Don't stress too much about making the wrong decision and as a result not do anything, because that is the wrong decision, is not doing anything. But in a nutshell, for both IRAs and 401ks, traditional accounts mean when you contribute for retirement, the government the government gives you a tax deduction. So you actually save money on taxes in the year you contribute because they want to encourage you to save for retirement, which means you get a bigger refund at the end of the year. But then when you take that money out, whenever you do retire, 65, again, 70 years old, you are going to have to pay taxes on that money because you never did, right? And so if it's $1 million in one of those accounts, maybe it's only $700,000 because once you take out taxes, it takes out a good chunk. Whereas a Roth account, you don't get any tax benefit today. So you can put up to the contribution limit in a Roth 401k, a Roth IRA. You're not getting any extra refund, any tax deduction today because it's post-tax money you're putting in. But then when you retire, the money in that account is already tax-free because you paid taxes already. And so the benefit of that is if you see $1 million in a Roth account, it's $1 million. And when you take it out in retirement, you don't have to worry about calculating taxes or anything as well. So again, which one's best, I think, is a question always people ask. And there's a lot of assumptions that go into it. I mean, if you're in a high tax bracket now and you think you won't be later, then you could try to take the tax deduction today. Or if you think taxes will go up in the future, then you really don't want to pay taxes in the future. And so you prefer a Roth, for example, because then whatever happens to tax rates, you've already paid them. So people try to strategize. I think, ultimately I have one of each, traditional and Roth. I put some in each because then, whatever would have been the right choice, I'm somewhere in the middle. And I think that can be a good philosophy as well. Is not stressing, again, too much about optimizing. There's a lot of unpredictability, but then at least, either way you have, some benefit wherever the tax rates happen to go in the future.
What about health savings accounts? What are they, and how can they be a useful tool?
Yeah, health savings accounts, or HSAs as we call them, are a relatively new thing as well that give triple tax benefits, which is really cool. So like I mentioned for these retirement accounts, they give tax benefits on one side, right? Either when you contribute or when you take out, but not both. What's great about HSAs is you get a tax benefit when you contribute, so they actually reduce your taxes, giving you a bigger refund when you contribute to an HSA. It grows. You can invest the money in your HSA, and it grows tax free. And then when you take it out, as long as you use it for qualified medical expenses, you don't have to pay taxes either. So it's really an amazing account because it allows you to avoid taxes completely. The catch is not a ton of people have access to HSAs. So typically the only way you can get an HSA is if you're in what's called a high deductible health plan, usually through your employer. But what that means is you're paying lower health insurance premiums. You're paying a lower monthly payment for your insurance. But then if something happens to you, you have a higher deductible. So you have to pay more out-of-pocket costs. And as kind of a reward for doing that, you get access to an HSA, which gives you a limit. I think right now it's about $3,500 for an individual to contribute to an HSA. And you can choose to put in as much of your own money as you want into this like tax protected account. But the catch is that you have to use it for healthcare expenses. And so, it limits you a little bit, but if you expect that at some point in the rest of your life, you'll have a lot of medical bills, especially if you're having kids, and you might as well start saving now in that too, and letting that money grow tax-free will just, make it easier for you to make all those.
So you really can build that health savings account up over time. If you don't spend that allocation each year, you have that benefit.
Right,
and you
exactly.
just add to it over time.
Yeah, it doesn't expire or run out, or there are flexible spending accounts which are different, that actually have rules about you have to use it by a certain date and things like that. But yeah, HSAs are great, and that you could not use any of the money. You could just make the maximum contribution every year. Sometimes your employer will put money in, and you could just invest that in index funds within your HSA. Let that grow for 30, 40 years. Maybe you'll have a few $100,000 in there. And it's interesting. So you could pay for future medical expenses, which especially when you're old, you'll probably have a lot of. Or you can actually reimburse yourself for past medical expenses too. So as long as you save your receipts, today, if you swipe your credit card today and don't use your HSA for a hospital visit or what a doctor's visit, way in the future, you can still pay yourself back with that HSA once it's grown, as long as you kind of save the documentation so you can prove it. So some people really use that strategy to get, again, another opportunity to get tax-free investment. So if you have access to one, it's something to check out for sure. Again, as long as you can afford to put money in there, and that you're already doing the right things for retirement in your emergency fund, because you don't want to lock it in this box for medical expenses if you're not ready to pay your rent if you lose your job. So there is still a priority mix, I think, of what to do first. The
next thing is, I think, initially scary, but there's a role for them I think you've used well, and that is credit cards.
Yeah.
What are some good strategies for you? Because at the same time, there's a lot of people who get credit cards and it ends very badly. So what are some good ways to use credit cards, and what role do they have in credit scoring and general responsible money management?
Yeah, there's a lot of debate on credit cards, and I think some people who are very helpful at personal finance, people like Dave Ramsey is a popular one, is very anti-credit cards. He usually cuts them up on stage, I think, and really urges people to not have them at all. And part of that comes from a place of truth. I mean, credit card debt is a massive problem, and what you may not realize is not paying your bill every month on time leads to massive interest that can quickly bury you and kind of get you stuck for a long, long time. So, there's some validity there about, hey, if you're struggling to kind of rein in your spending, there's been a lot of research on this. Swiping a credit card is easier than paying with cash. You don't feel the hit as much. So, ultimately, I think my philosophy is I like credit cards. I feel like I use them responsibly. I get great benefits and points from them. But if you're struggling to kind of keep within those spending targets you set for your budget, or especially if you're finding you're not able to pay off the balance on any month, I would say then totally cut them up and either use a debit card, which won't let you overdraw on what amount of money you have, or actually give yourself a month or two where you do what Dave Ramsey says and actually bring cash around in different envelopes. And if you can't afford it, you can't buy it. So it depends, I think, where you feel like you fit in your ability to control your spending. But that being said, you talked about credit scores briefly. The most important thing for your credit score is paying your bill in full every month on time. And the easiest way to do that is just to set it on auto pay. So, whatever credit cards you have, just connect them to your checking account, set it on auto pay, and it will make sure you don't miss any payments because you don't want to be on vacation and forget and have that hurt you. So as long as you kind of get that set up and you can keep affording it, then great. Credit cards can give you, I have a great credit card from Citibank that gives me 2% cash back on everything, right? So that's a 2% discount on everything I buy. And as long as I use it responsibly and pay it off, I mean, that's a great little way to save money too. I just need to be careful that I don't swipe it for more things than I would buy if I actually use cash.
Yeah, I mean, they can be a great tool. I mean, I use my credit card to pay my student loans, but then I immediately move the money from my account, my checking account, immediately to the credit card. So I get the points
Totally.
for spending the money, but I'm not spending money I don't have.
Right. Yeah, and that's, I think, as long as you're diligent about it, it is the key. And one great thing about Mint that we talked about with budgeting earlier is it syncs all your credit card transactions. So it makes it very easy for you to look at across all your different credit cards, what are you spending in these different categories each month? And that's a helpful way for you to start looking at, are you spending more than you really feel like you should be in these areas? And is that, maybe you try a month with just cash and you compare and say, hey, am I actually spending more because it's the ease of taking out this card? Or even now just entering it on a website, right? It's easy to buy stuff from Amazon when you don't really have to mail them money. It just click a button and it shows up.
You don't feel anything. You just get the little excitement hit when it rocks up at your front door. And then you see your credit card bill and you're like, how much?
Exactly. I think, yeah, even me who uses my credit cards responsibly, I think my bill always seems higher than it should be. But that's good. It encourages me to look at everything I bought and kind of feel the pain a little bit at the end of every month and say, okay, like this is why it's so high. I remember those decisions I made, and hopefully then it helps me to to reevaluate the next time I'm at Starbucks and deciding if I really need to get a venti or not.
I do want to turn to some questions that I've had from listeners, but before that, I want to talk about the flavor of the month. NFTs. What is your take on NFTs, and help us understand what are they?
Yeah, I think it may be an unpopular opinion, but perhaps actually pretty widespread if you read some of the articles. So I'm not big in the crypto world. I think overarching before we even get to NFTs, I personally don't think putting money into Bitcoin is investing. I think in many ways it's speculating or gambling as well, right? It's
volatile.
Right. People are putting money, just like GameStop, assuming that it will go up for no real tangible reason, right? We've kind of realized, I think, at this point that people aren't going to use Bitcoin to pay for things. And so now it's just, well, buy it because it'll go up, which that's a really dangerous thing. I think there's a lot of risk there. That, sure, some people have made plenty of money in Bitcoin and even some of my friends and family members, but, ultimately I still think I'm making the right decision by looking for the long term and not trying to make quick money. And remember, investing in cryptocurrency has a lot of tax implications as well. And so people sometimes don't think about, if you use some of these sites, you'll get a huge tax bill by trading in out of different coins that you might not even realize. So just stuff that I prefer to avoid. NFTs are kind of the newest stage, I guess, in this saga, which non-fungible tokens is what they stand for, and it, in essence, it seems like people are trying to use a similar technology of Bitcoin to kind of give people ownership of unique things, and the price is getting, unique things such as like artwork, like kind of digital artwork is what people are doing.
The cat on the rainbow GIF.
Yeah.
It's like, I think it sold for something like $500,000.
Right. And so some of this, it's when you really think about it, it's driven by a bunch of insanely wealthy people, I think, who have nothing better to do and think it's kind of funny. But I don't think it's a smart idea for people who are trying to build up their life savings to take that risk. And yeah, again, the reality is you're not really investing in anything tangible here. And at some point, people are going to decide, okay, this is like not actually worth it anymore. And you don't want to jump in right before that moment where you lose everything you've been working your whole life to save because you bought a cat on a rainbow. So yeah, I think my advice for this stuff too is just honestly, I think stay away. I don't think it's worth it. I think sure it's funny to watch, but it's especially when you start to have a family, as I do now, you start to view your money less as like kind of like a personal individual, like what the heck type thing. And my money now is more of like a ability to provide for my family and provide safety and security. And I have no desire to risk that to make a little more. I would prefer to bet on that long term kind of stable growth rather than doubling my money and buying a Ferrari tomorrow or whatever it is.
Yeah.
So
Well, Danny, let's turn to some questions.
sure.
So our first question is from Richard. He says, I'm 40, single, and frankly scared about what lies ahead. I have very little savings, no investments other than 401k, and in a job with limited mobility. I lost most of what I had in a business that failed due to COVID. I'm in California, which is part of the problem. And then the question, I can't say exactly what he said, but he said, am I totally in trouble? Let's just put it like that. Or is there a way out?
Yeah, that's a tough question, and unfortunately, a relatively common one after this pandemic. I think ultimately, before we even jump into the like tactical stuff, I think it's important to stop and remember too that the money isn't everything, right? And so, as important as all this stuff is, money, is just a tool that allows us to have more independent, happier lives. And so, ultimately, I think as much as you can seek to find joy in the relationships that you have, and in the small acts of kindness that you can do for people, I think those are still important. And at the end of the day, being wealthy often won't make you happy. But that being said, it's totally valid and worthwhile to stop and think about, okay, what can I do, over the next 20, 25 years to be better prepared for retirement? And it sounds like based on Richard's job that there's not a ton he can do there. And assuming there's no way for him to switch jobs or really kind of find somewhere with more mobility, then you really have to think about, okay, what can I change in my own life to help save a little bit more? Maybe that's looking at where you're living and thinking about, is there a way in this new remote world to live somewhere cheaper and not need to be downtown, or maybe you don't need as much space as you think you do, and that's hard to admit sometimes. But especially in California, I imagine real estate's a huge chunk of expenses. But then I think again that's where accountability helps too. Can you find a friend to help you think about what you might be able to do and save in that monthly budget, and even if it's just 100 $200 a month over 25 years, that would add up a lot, and at least give you some more cushion. But then also I think one thing that a lot of people don't think about enough is time and the value of our time. And so, one thing that is really worth thinking about is in your free time at night, what are you doing to better your financial position? Is there something else that you can start doing to find ways to get extra income rather than maybe watching Netflix or whatever it is that you do in your free time? Is there something that you can help provide to people that's useful, or I think driving for Uber or Lyft are not great financially, but hey, if you have a time and nothing else, you might be able to make a little extra cash that helps you at least get started saving. And there's a lot of opportunities to do freelance work as well. It's really up to you to be creative, I think, and take ownership of this. But ultimately, I would say don't despair. Like we said, it's never too late. And the fact that you're willing to look at your life now and say, hey, what can I do to make it better? There are so many resources and ways to kind of jump in and do as much as you can. It doesn't mean you'll make millions of dollars, but at the end of the day, you don't need that to be happy either. And that's, I think, something important to remember.
That's a good point. Next question is from Leon. He says, I graduated last May and after a long search have finally found a role starting in May of this year. It's at an accounting firm. Should I be trying to save and invest, or should I be sinking every spare cent that I have into my student loans? I'd hate to pay it off or at least down only to find out that it will be forgiven later.
That's a great question. And I think definitely one of the challenges with this debate over student loan forgiveness right now is the uncertainty it provides to people who want to do the right thing and pay off their student loans, but don't really know when or if this might happen. So I think the first principle to keep in mind is keep, heck, I mean, right now, there's no interest on student loans with COVID still. So at this point, as much as you can, I think build up that emergency fund, especially, even though you haven't started your first job. It's great to have that ready as soon as you can. And honestly, max out that employer match. So if it is an accounting firm, it's very likely they match at least a few percent of your income to retirement. So definitely get that doubling your money bonus, even after they start to require interest on student loans again. So I think those two things are still the first priorities. Once student loan interest comes back and those payments start again, I think still focus on paying that minimum balance every month and make sure that you're able to keep building that emergency fund, max out your retirement. And then at some point you can kind of decide, do you want to pay extra on your student loans, or do you want to focus more into retirement and save early? And it depends a little bit on what the interest versus rate of return is. So, the interest on your federal student loans depends, of course, what kinds of loans you have, but it might be 5 to 7% or something. So if that's the case, you might be able to get a slightly better return investing. However, you might just enjoy kind of getting rid of the student loans and not having them on your back. And so in that case, maybe you decide to pay more of them off. And really, I think you'll have to kind of watch the news and see what happens with forgiveness. I don't have a crystal ball there. But personally, I don't love having debt. I want to pay off my student loans as quickly as possible after grad school, even though I might be delaying some of that bigger retirement investment a little bit. But as long as you do the emergency fund and max out that match first, then it's really the choice is up to you, and you can decide what makes you more comfortable.
There you go, Leon. Deanne asks, how should I go about setting up something automated? Should I just invest in an ETF that matches the S&P 500 and forget about it, or do I need to diversify further? Also, I keep hearing about precious metals. Do I need to include these in my approach?
Interesting question. I think in general, you can automate into an ETF that tracks the S&P 500 primarily, especially if you're young. I don't know how old this person is.
She doesn't say.
Yeah. So especially when you're young, tracking just an overall stock market index fund is a common approach that many people take. Generally, many of these investment managers recommend having some percentage, perhaps 20, 30% in international stocks as well. But again, there are very low cost index funds that you could automate this, whether you do it at Vanguard, as I do, or if you use something like Betterment or Wealthfront, some of these robo-advisor startups that will make it very easy.
Even Stash, there's an app called Stash where you can invest in an ETF for as little as $5.
Yeah,
and you can automate it so that it does it once a week, twice a month, once a month, and you just forget about it.
Yeah, and Betterment Wealthfront too, I think will now have automatic withdrawals from your checking accounts, and they'll split it among retirement versus your emergency funds. So you can kind of do all that saving very, very easily. So yeah, a lot of good options. I think, the right mix of stocks or international stocks or whatever depends a little bit on your age and your risk tolerance, which is a kind of how comfortable are you with ups and downs in the market. But any of these sites have great ways to do like a 1-2 minute quiz that will help you decide what that allocation is. I think on the precious metals point, I think, if my general recommendation is if you hear something, people talking about it a lot, it's typically
it's too late.
Not great advice, right? So for something like that, I think that's a pretty uncommon thing and not something that you need to do by any means. And I think there's plenty of risks there too. And so again, I would keep it simple as much as you can and focus just on those lower cost index funds. And again, look for that long-term growth rather than trying to, to get lucky with something else. So those websites I mentioned will be good starting points to help guide you through like what's a normal average allocation for your first investments, and then like you said, you set it, forget it, and really don't have to spend that much time worrying about it.
That's a good one. Alyssa asks, I desperately need a new car. Should I buy one that I can afford, which isn't much, but it would do, or should I take advantage of something like the 5-year interest-free deals that many dealers often have, and the lower maintenance costs that would come with a new car?
Yeah. I think as someone who hasn't owned a car in 4 years, I think were I in your shoes, I would do option A, which is probably what you think you knew I would say. So I think I haven't owned a car in 4 years because I don't really need one. I live in the city and I walk everywhere. So I think cars are not the greatest asset because they depreciate, right, every day, even if they're sitting in the parking lot.
Even a new car, the minute you drive it off
Oh
the lot,
yeah,
it's lost value.
exactly. And so for me, I prefer to invest my money in things that grow rather than deplete my money. So for me, I would honestly pick an affordable car, something reliable that will last a long time and that you don't have to stress about. A lot of those dealership deals might seem really great, but they bake in a lot of fees and things you don't think about as well. And for maintenance, I think they often overestimate how much maintenance you'll really need to make you think you're saving all this money. But the reality is like a lot of the stuff actually isn't really necessary, or it's a lot cheaper if you went somewhere other than the dealer. But of course,
Yeah.
they want to lock you in so that they can mark it up and make their money back. I think remember that the dealers have to make money somehow. They have massive buildings, tons of cars and
Staff.
employees.
Yeah.
And so they're making the money from you somehow on those arrangements. And maybe it's not transparent, but nothing's really, really free. And then even Robinhood, I think people have now realized that Robinhood isn't really free stock trading. That they are making money from you. It's behind the scenes and you don't know it. So that's what I would say: buy the affordable car and use the money you save there to invest in one of those ways we talked about, and that'll pay you off in the future. And then maybe when you're retired, you can buy that Ferrari and it won't matter. So.
Here's a good one. It's from Carlin. This one's got some meat to it. Carlin says, I'm a first-generation American who was the first in my family to get a college degree, and I feel a lot of pressure to earn a lot and to look a certain way, new clothes, cars, etc., and to provide for my family. I have no idea how to be independent or how to make my own financial choices. I want to please my family as a sign of gratitude for the help that they gave me to get me where I am. I don't yet make 6 figures, but am likely to in the next 5 years. It will be more money, and it's more money than my parents ever knew, but I don't know how to manage their expectations.
That's a really, really tough question there. I think, again, the most important thing is that providing for your family piece. I think ultimately that will bring you and them the most joy, more than any new cars or new clothes or anything. I think it's very easy to fall into these societal expectations of what wealth looks like. But at least in my experience, the people who look the most wealthy, even including many of our celebrities or perhaps our latest president, it's people who appear super wealthy sometimes actually aren't, right? They went into a ton of debt, or they really are stressed and trying to figure out how to make ends meet. And so to me, the truly wealthy people are people who are not flashing it around, but are making smart decisions to care for the people around them. And I think emotionally that makes them wealthier as well because they don't have this pressure to look a certain way. And that extra money they save, they can do good in the world as well. So, I think it's a hard thing figuring out how to be financially independent and making these decisions. Fortunately, there are so many great resources and people out there who are willing to help and give honestly good free advice. So NerdWallet, I think, is a great place. There's a subreddit for personal finance that I think has a very good flow chart and for the most part, very good people at helping answer specific questions and helping make sure you don't kind of get misled and paying more fees than you should. So just dedicating some time to learning and being open to that, I think is a good starting point. And remember that this world is less complex than it seems. The financial institutions want to make it seem more complex so that they can charge you more money to do it instead of you, but you can do this on your own. It is totally possible and relatively easy once you kind of learn some of the basics and just avoid all the rest.
That's a good answer. I hope that helps, Cullen. Last question. It's from Tim. It's broad, so we don't have a lot of information, but he just says, grad school or an entry-level job? What are your thoughts?
Like right after undergrad,
I'm assuming that's what he means, yeah.
So I think that depends a ton on career. If you're getting an MBA, 100%, as I am, 100% do the entry-level job first. MBA programs really prefer that you work first because they often help. The goal is that you'll figure out a little more what you enjoy doing before you go do an MBA. For law school, I know Ben is a little more of an expert, but a lot of people go to law school right after college, and maybe that's a little wiser because you need the law credential before you can really do any work in law. So,
well, people forget that average first-year law student is 26 or 27, depending on the study that you look at.
Well, there you go. See, I don't even know.
For very similar reasons.
Yeah.
Because you don't know anything when until you start working. You learn all the stuff that no class is going to teach you.
Yeah, that's a great point. So that's something to keep in mind. Then I guess if you are so convinced, maybe medical school is a better example. If you know exactly what you want to do, medical school is a decade-long journey. So you might as well start and do it. But for many other careers, there's nothing to lose by taking 1 to 3 to 5 years to try some jobs and figure out what you like, and it might avoid you honestly going into a ton more debt for a degree that you will end up never using. I think too many people go to an MBA or to a master's program or to law school, and then they graduate and start working and realize, oh, I actually can't.
I hate this.
Job.
Yeah,
I hate this. And now they have a degree that is kind of useless, and they have to go get another degree. They think, right, to
that's going to cost them.
Job. Exactly. And that's, I think it's worth taking a few years in the real world, whatever it is. I mean, it doesn't have to, I worked at a consulting firm, but it doesn't have to be that. I mean, you can teach English in another country. I have a guy I just talked to today, works for an orchestra, whatever you think might be interesting. I mean, this is your chance to try it out, and grad school will still be there. You'll be able to talk to people who went before you and get a sense for, is it worth going back to school or not? And I know a lot of people who chose to go back to school and love it. I know a lot of people who, after a few years of working, thought they would go back and then decided, you know what, like, I'm getting promoted quickly, I'm making a lot of money, it's not worth it for me to go back. And they're totally happy with that decision, and it's a good thing that they waited.
Yeah. I mean, Tim, that's the whole reason we started the Professionists, because there are a lot of people who marry themselves to a graduate program before they really know what they want to do. And it's okay to take some time just to get some entry-level work experience. That's going to build your resume. That's going to make you more employable if you do decide to go to grad school because you've got some experience. So, I think as a rule, unless you know why you're going to go and what the end goal is, don't go to grad school just to hide from what you perceive to be a tough job market. And keep listening to the podcast. We're going to explore a lot more professions in season 1. Like, share, and subscribe. Leave us a review, and we'll find your fit over the course of this season and the ones that follow. Danny Huizinga, this has been really helpful and insightful. Thank you so much for making the time and for joining us.
Yeah, thank you. It was great to be here.